We detected an unusual trade worth $4.2 million on Amazon stock, ticker symbol AMZN. And so in this video, we will analyze this unusual option activity to find out if this wealthy investor is bullish in buying or bearish in selling, because as we all know, the rich have more access to exclusive research and information, sometimes even leaked insider information, allowing them to make better financial decisions. This is why smart money always stays one step ahead before the rest of the market catches on. No wonder the rich keep getting richer. And so, to level the playing field, let's dive into our analysis to gain insights from the rich so that our subscribers and members can profit from this deep knowledge too. As we can see here on the options time and sales tape, the most unusual trade happened on March 25th at 1:28 at the 20-second mark for these July 18 options at the 205 strike calls and the 225 strike calls. Now, you may be wondering why the May 16 options at the 230 strike calls was not the most unusual trade. Well, because when we dive deeper into the data on the option chain, we can see here for the May 16 options at the 230 strike calls, we have an open interest of 18,571 contracts, which is more than the volume being traded. And so this wealthy investor could be closing these options and not necessarily opening a new trade. With that being said, when we dive deeper into the other unusual trade for the July 18 options at the 205 strike calls and the 225 strike calls, notice that in this case, the open interest of 3,000 contracts is much less than the volume of 5,000 contracts. It would not be possible to close out 5,000 contracts if there were only 3,000 open contracts. And so there is a good chance that this wealthy investor was opening new contracts and not closing out contracts. And that is why these July 18 options are the most unusual trade. And so we can calculate the estimated cost of this trade, the price of 15.28 minus 6.75. Keep in mind that options are priced per share, so we need to multiply by 100 since each options contract represents 100 shares of stock, and so each contract or trade costs $853. And since there was a total quantity of about 5,000 contracts, we multiply that out and we get a total of $4.2 million for this trade. But keep in mind, this is a higher risk trade in comparison to the trades that we share on our website. And so if you want to get access to the lower risk and higher probability of profit trades, then go to our website. We'll put a link to our website here where you can get deep insights into exactly when and which stocks wealthy investors are trading on Wall Street so that you can have the same opportunities as the rich. Because if the rich get richer, why shouldn't you? Now, with that said, even though this is higher risk, we still traded this, but we use position sizing to manage our risk. As you can see here on the option chain for the July 18 options at the 205 strike calls and the 225 strike calls, since this was a new opening trade, we also traded these call options and got into the same position here. POS stands for our position, and the green color means a buy position, and the red color means a sell position. Because based on our deep research and analysis of multiple variables and data sets, this wealthy investor bought these 205 strike calls and sold the 225 strike calls as a vertical call spread for about $8.53 each, the same price as we calculated and saw earlier on the options time and sales tape. And so when we analyze this trade, you can see here on the risk profile profit loss graph where the x-axis represents the share price of the stock, which is currently trading over here, and the y-axis represents the amount of profit or loss. Note the zero break-even line here. And so when the purple line, which represents the current date, and the blue line, which represents the option's expiration date, are trading above this zero break-even line, As the share price goes up, this trade becomes more positive, profitable. And if it trades below this zero break-even line, as the share price goes down, this trade becomes more negative loss because this is a long bullish trade. And we can confirm it here on the Greeks. We have a positive delta trade. If it was a short bearish trade, it would be a negative delta. But be aware of the risk of this trade. We have a negative theta decay, which means that as time goes on, this trade will lose in value. And that is why you can see here the purple line drops down lower to the blue line as we approach the option's expiration date. Since these options lose value through time, the break even on this trade moves higher as time goes on. And so you can see here, even though the long call options we bought have a strike price of $205, the stock needs to trade above $213.56 per share for this trade to be profitable at expiration. Because of this added risk, along with other factors, we only took a small position in this trade. We don't invest a lot of capital into these higher risk trades. Instead, we focus most of our capital on lower risk, higher probability of profit trades, the kind of trades we share on our website. We'll put a link to our website here where you can also learn more trading strategies to increase your profit potential. Let us know in the comments. Are you bullish or bearish on Amazon stock right now? As always, please like, subscribe, and until next time, let's keep tracking the trades of the rich so everyday investors can profit too. Take care and have a wonderful day.